All right, we've all seen it. The absolute explosion in so-called free trading. Millions and millions of new people are piling into the stock market. But what if the story we keep hearing about them, that they're all getting fleeced on hidden costs, especially in the crazy world of options? What if that story is missing a massive piece of the puzzle? Let's dig into this. So first, let's just set the scene. The surge in retail trading since 2020 has been, well, historic. And a huge part of that is happening in options. We're talking about retail traders now making up something like 40% of the total options volume. This isn't some little sideshow anymore. This is a major force in the market. And the story you almost always hear, it goes something like this. These new traders, they're unsophisticated. They get lured in by the promise of zero commission trading, only to get absolutely hammered by these invisible costs. The narrative is that they're just gambling, making impulsive trades, and paying a really heavy price for it. Okay, so let's properly introduce the main villain in this story, at least according to the conventional wisdom. It's this little thing called the bid-ask spread. For years, academic studies have put a big, scary number on this hidden cost. The accepted figure for what a retail trader pays for one round-trip options trade, so buying and then selling, is a whopping 2.59%. Now, if you pay that over and over again, that's a recipe for blowing up your account. So that number seems to seal the deal, right? It proves the story we've been told. But what if it's not the whole story? What if that number and the entire narrative built around it is just wrong? What if we've been looking at all of this from the completely wrong angle? Our first clue that something's a little off here comes from a place most people never even think to look. These super detailed reports that brokers have to file, and what's inside them is a total shocker. Now, for stocks, the data kind of fits the old story. About 17% of retail trades are what we'd call strategic limit orders. That's where you set a specific price you're willing to pay, instead of just taking whatever the market is offering. It's a minority, which suggests, most people are just hitting that buy now button. But then you look at options, and this is the twist. That number doubles. A full 34%, more than a third, of all retail options trades are these strategic limit orders. This is not some small group of savvy pros. This is a huge chunk of the market behaving in a much smarter way than anyone gave them credit for. And the researchers who found this basically said, hey, this frequent use of limit orders, especially in options, completely challenges that old idea that retail traders are just passively accepting whatever price the market throws at them. So what is this big deal about different order types anyway? To really get what's happening here, we have to kind of pause our investigation for a second and break down this really fundamental choice every single trader makes. Okay, think of the bid-ask spread like the currency exchange booth at the airport. You see a buy price and a sell price for euros, and there's always a gap between them, right? That gap is how they make their money. It's the transaction cost. If you want to trade instantly, you have to cross that gap and pay their price. So here's the crucial difference. A market order basically screams, I want in right now. I don't care. Give me the best available price. And for that speed, you pay the spread. But a limit order says, hang on, I'm only willing to trade at this price or better. With a limit order, you're giving up speed for a better price. And get this, if you're patient, you can actually earn a piece of that spread yourself. And here's exactly how it works. A smart trader doesn't just have to accept the prices they see. They can place a limit order inside the current spread. And by doing that, they literally become the new best offer in the market. They just flipped the script. They went from being a price taker to a price maker. Okay, so we know retail traders are using these strategic limit orders way more than anyone thought. So what does that do to that big, scary 2.59% number we saw earlier? Well, get ready, because here comes the big reveal. So this is the old way of thinking. All the conventional studies were based on this one simple, but, as it turns out, very wrong assumption, that every single retail trader is just a price taker, always paying that full spread on every trade. But when these researchers actually accounted for how people were really trading, whether they were paying the spread or earning it with a limit order, that number just collapsed. The real, true cost of a round-trip options trade for a retail investor isn't 2.59%. It's 1.07%. Let's just sit with that for a second. That is a 60% reduction in the estimated cost. The whole story that retail traders are getting bled dry by hidden fees isn't just a little bit wrong. It is off by more than half. This completely rewrites our understanding of what's going on. So, okay, what does this actually mean in the real world? It's not just about some number getting smaller. This forces us to completely rethink who the modern retail trader really is. This might be the single most powerful finding in this entire study. When they looked at what explains the difference in trading costs from one person to the next, they found that individual choices, your skill, your strategy, accounted for 71% of the difference. And the broker you used, the free trading app, less than 1%. It's not the app, it's the person using the app. And this skill, it's not just a fluke. They found that being good at executing trades is a real, repeatable skill. Traders who were the best at keeping their costs low in the first half of the study had a 52% chance of staying in that top group in the second half. It's not just luck. So the takeaway here is pretty clear. That old story of the helpless retail gambler, it needs a serious update. A lot of these traders are actually acting strategically. They're actively using the tools they have, like limit orders, to manage their own costs. And at the end of the day, their success or failure has way more to do with their own skill than with whatever logo is on their trading app. And that leaves us with one last kind of provocative thought. For years, the conventional wisdom on this was just accepted as fact. But now we know it was just deeply flawed. And it kind of makes you wonder, right? If the experts were this wrong about something so fundamental, what else don't they know about how today's markets actually work?